Equity markets had a strong month in June, with the MSCI World Index up over 6% in sterling terms, continuing the strong run this year. Much of this improvement has been driven by interest rate expectations and bond yields. Nominal yields on the 10-year US Treasury fell to below 2% this month. Investors are paying up for the certainty of return that government bonds offer. Indeed, Germany sold bonds last week with a zero yield. Investors lent money to the German government last week and will get it back the same amount in 10 years' time, having received zero interest payments. This backdrop makes the value of equities more attractive as they have significantly higher yields, with dividend yields as high as 6% in some cases in our portfolio. The opportunity for capital gain exists as well. Therefore, we think we can beat the 0% return over 10 years. Equity markets are being driven more by this interest rate or discount rate factor, rather than the growth in cash flows that stocks can generate. We're just starting the second quarter earnings season, and there will be significant focus on whether companies can continue to generate increases in earnings, particularly their insights into future earnings guidance. Many commentators are focused on the threats to future economic growth, the late stage of the economic cycle, and some of the weak economic indicators recently. Predicting the direction of markets in the short term is not what we do here on the Royal London Global Equity team. Instead, we focus on understanding the wealth creation that companies can deliver to shareholders. To do this, we focus on understanding how businesses make money and what their value proposition is to customers and how durable these are. We focus on the external environment of the industry that they are in. Is their capital entering or leaving the industry, for example, and what the regulatory regime is if that's appropriate. We also focus on management's ability to deploy capital effectively in shareholders' interests, and importantly, if there is alignment between the way that management is incentivized and the interests of shareholders. As part of our investment process, we review the earnings reports from the companies that we're invested in every quarter. We assess the continued wealth creating ability of the companies to ensure that they are delivering relative to our expectations. We also check the valuation payoff for these companies to ensure that they remain attractive investments. In the long term, wealth creation of individual companies in the portfolio is what will drive performance. But in the shorter term, we expect the discount rate factor to remain dominant. These are strange times when governments can borrow money for nothing.